Okay, you'd think that casually upgrading your revenue target for next year by literally billions of dollars would earn you a little grace with Wall Street, but apparently AI investors are an entirely different breed. Welcome to Earnings Unscripted. It's August 27th, 2026, and today we're looking at Marvell Technology, ticker MRVL, and their second quarter results.
Yeah, tough crowd's an understatement. The tape was an absolute bloodbath after the bell. It gapped up pre-market, drifted all afternoon, and the second the actual earnings call started, the bottom fell out. They dropped over 9% in extended hours.
Which feels wild when you look at the physical growth. And before we get too deep, Miro and I are simply sharing our personal read on the market reaction here, so please don't treat any of this as financial advice. But looking at the actual prints, total net revenue came in around $2.74 billion, up 37% year over year, and bottom line earnings comfortably outpaced last quarter too.
Right, except margins are the real story here. The data center's doing the heavy lifting, obviously, but Matt Murphy talked heavily about this accelerating ramp into custom silicon for the hyperscalers, and custom chips inherently carry lower margins than merchant components. So, as that specific volume explodes, overall profitability gets temporarily anchored.
Okay, wait, back up. So they're winning the absolute biggest AI infrastructure deals on the planet, but they make less profit per chip on those specific deals?
Precisely. They're sacrificing short-term gross margin to build an undeniable structural moat. Their new CFO, Dan Durn, is practically fighting a two-front war right now. He's trying to enforce long-term operating targets while simultaneously writing these enormous cash prepayments just to secure advanced node capacity at the foundries. The supply chains are just that constrained.
Because if you don't buy your place in line today, you have absolutely nothing to sell tomorrow.
Exactly. And they know exactly how much they need to build. Murphy sounded incredibly confident about their forward pipeline. In fact, he aggressively hiked their fiscal 2027 target to roughly $18 billion.
That's massive, but it also relies heavily on that secretive new commercial agreement they teased. They're tying up a major hyperscaler with a giant equity warrant package, which sounds great for locking in long-term revenue, but I want to know exactly how much that dilutes the existing shareholders while they wait for this custom silicon to actually print cash.
Well, that's the real rub, right? Management paraded this commercial agreement around, calling it a massive validation of their whole custom strategy, but they completely sidestepped pricing the actual revenue attached to it.
So they didn't put a number on the size of the deal at all?
Not explicitly. Murphy just told analysts, quote, "You should assume starting in FY 2029 beyond, whatever you have modeled previously prior to the warrant for custom numbers definitely goes higher."
Oh, that's very convenient. Trust us, it's huge. Just ignore the dilution until then.
Right. They acknowledge the equity warrants will absolutely dilute current holders, which means they've got to keep buying back their own stock just to tread water on the share count. It's a wildly expensive way to lock in a customer.
So wait, I'm trying to visualize what this actually covers. When I hear XPU attach, my brain instantly pictures the core AI processor, like they're trying to build a bespoke GPU to compete with NVIDIA. Is that what's dragging their margins down?
No. That's exactly the misconception. They aren't trying to displace the main AI engine. They're building the nervous system around it. We're talking custom inference accelerators, storage controllers, network and memory interfaces.
Okay, so it's the connective tissue that makes the whole cluster actually run.
Exactly. And that connective tissue is where the physical bottlenecks are happening right now, especially with memory. Look at their old bet on CXL.
Compute Express Link. Didn't they start pushing that for regular data centers a few years ago?
5 years ago, yeah. They dumped internal R&D into CXL, aiming at a totally traditional server-centric memory architecture. But it turns out this current generation of hyperscale AI environments suffers from an acute memory scarcity problem. They just burn through physical capacity.
Because hyperscalers desperately need to optimize the power they're drawing to generate tokens, so they just need memory expansion everywhere.
Spot on. So this legacy organic pivot is suddenly the perfect plug-in for AI inference. Murphy essentially took a victory lap on the call. Quote, "It turns out all that investment we've made is just ideal for memory expansion and inferencing as a result of the scarcity that's out there in memory."
That's amazing. Sometimes it really pays to be early and accidentally right.
It doesn't hurt, but I actually think the networking side is an even weirder dynamic. Look at what's happening with the interconnects. The consensus assumption was always that high-speed optical networks would completely displace copper in the data center.
Right, because you eventually hit a physics limit with copper, so everyone's forcing a move to co-packaged optics. That's the whole thesis, isn't it?
That's the story, but it isn't the reality right now. Customers aren't ripping out copper. It's an and, not an or.
Wait. They're deploying both in the same clusters?
Yeah, because they're pursuing varied architectures simultaneously, depending on the specific workload. Again, Murphy was blunt about this. Quote, "Our customers have varying architectures that they're pursuing. We see this as an and, not an or. And I think the magnitude of our scale-up optics opportunity next year is much larger than we thought." So Marvell gets to sell their established Terralinx copper switches to one customer while ramping those new SiGe optical products for another.
Wow. So they effectively capture the entire addressable market, regardless of which architecture the client chooses on any given day.
Pretty much, which perfectly explains why Dern's out there locking down foundry supply at all costs. We mentioned those prepayments earlier. They project spending roughly $1 billion in FY27 just to guarantee they've got advanced node supply from the fabs.
And that brings us right back to the central tension here. If you're fronting a massive chunk of cash to build these lower margin custom chips, how long can you genuinely ask the street to wait before the operational scale kicks in and covers that check?
Honestly, the market's saying they won't wait at all. That's why the stock tanked. Investors see those prepayments and want immediate profit. But the CFO's basically telling everyone to hold their breath until the end of the year.
Right, because Dan Dern promised they'd hit their long-term operating margin target by the fourth quarter. It's supposed to return to that 38 to 40% range. So the third quarter is basically a gauntlet they have to survive.
Exactly. And management's third quarter guidance does a lot of work to keep people on board. They're targeting revenue at a midpoint of about $3.15 billion. The top-line growth is undeniably there, but you can clearly see that custom scale-up.
Because the profitability takes a hit. The guidance. They guided third quarter non-GAAP gross margin down to somewhere between 57.5 and 58.5%. It really highlights how painful that custom scale-up actually is.
It's a deliberate sacrifice, and they're trying to ease the sting by bumping the full-year revenue outlook up to roughly $12 billion. But I was going to say there's another vulnerability hiding underneath all this momentum.
Oh, the communication segment. Because management did call out, well, they called it typical quarter-to-quarter lumpiness, which always just sounds like a polite way of admitting it's struggling.
Right, except lumpiness just translates to unpredictable dead weight. They're projecting a sequential decline there next quarter. So while the data center side's a speedboat, that legacy telecommunications piece just acts like an anchor.
That's a great visual. It's truly a tale of two businesses right now. I guess the big unknown going into the end of the year is whether the sheer scale of these hyperscaler networking deals can overpower the margin pressure and that legacy anchor.
That's the entire gamble. If they can absorb those massive supply costs and still hit that Q4 operating target, they'll look like absolute geniuses. But if those custom chip margins compress even a fraction more than expected, the narrative gets incredibly tricky.
Well, no pressure on the new CFO then. He clearly has a wild couple of quarters ahead of him. We'll definitely be watching how that custom pipeline translates into actual cash flow next time.
Always a pleasure. Catch you later.
If you enjoy these quick breakdowns, tapping follow on your players a great way to catch them all. Just as a heads up, this entire show, from the script to our voices, is completely AI generated, designed to compress a live earnings call into your feed the exact same day. We'd really love to hear what you think, or which ticker we should tackle next. So just drop us a line at earningsunscripted@datamadness.ca.
Talk to you soon.